First and foremost, the AI industrial revolution, its ubiquity, how important it is, how it will play out.
As 2026 approaches, we asked Neil what he thinks the big drivers will be for the global economy and which sectors he'd pick for an investment strategy for the new year.
Investors got it wrong at the start of last year. Investment banks were saying China's uninvestable. That was nonsense. Most of the scare stories I see on the internet are ludicrous, frankly.
So the EU is still a story of missed opportunities.
There are some really interesting undervalued situations across Europe.
Which sectors globally do you favour going into 2026?
So I still see opportunities in...
Welcome back to Noise Cancelling. As this is the last episode of 2025, I thought it would be a good time to walk through Neil's big calls for 2026. What could actually drive markets over the next year, what could go wrong, and crucially, how he would build a strategy around it. We'll cover AI, whether it's a revolution or a bubble, China, whether it's uninvestable or mispriced, the US, whether it's resilient and united or fragile and fragmented, the UK, long hated by investors, but in Neil's view, still full of opportunity, and the EU, where security, energy, and regulation are holding it back. At the end, we'll ask Neil to put it all together and ask, if you had to build a strategy for 2026, what would it look like? Before we get into the episode, about 70% of the people watching this aren't subscribed. If you want more long-form conversations like this, hit subscribe, turn on the bell, and let us know in the comments where you're investing for 2026. Neil, it's been a busy year. Let's set the scene for 2026. Give us the 60-second version. What's the world we're walking into in January?
You know, in the space of a few weeks, not much is going to change, okay? But I think there are some important themes in 2026 which will be new and will become increasingly apparent and which slightly contradict where consensus is. So for me, what's really interesting is, first and foremost, the AI industrial revolution, its ubiquity, how important it is, how it will play out. What's very interesting is that the AI industrial revolution and its ripple effects are having a much more profound impact on geopolitical policy, US politics, and the US economy than you might think, than many people think. That's one theme, I think, which will emerge in 2026. Perhaps the other theme that's going to be quite significant, I think, in 26 is that the policy uncertainty that I think has been characteristic of 2025 with a new president and all the new things and the new approaches that Donald Trump brought with that. I think going into 2026, despite the fact at the back end of the year we've got the midterm elections in the US, actually less policy uncertainty is going to be the theme of the day. So I think we're going to have less policy uncertainty, less policy disagreements in the US in many respects domestically, but also I think 26 will be characterized by less trade tension between China and the US, and that's going to be quite significant. So the policy environment, the policy backdrop will be less disruptive, in my view, in 2026, and I can explain why in a bit more detail later.
Are we heading into 2026 in better or worse shape than people think?
In general, I think in better shape. Interest rates are coming down across the developed economies of the world. That, of course, is very important. Inflation's coming down. The world seems to me to be a less risky place now, albeit that we still have a major war going on in Europe, and of course that is a major concern for the continent. But in general terms, when I think about where we were at the start of last year, with the unknown quantity of a new US president who we knew was going to be pretty radical in many respects, and where we are today, I think we've acclimatized to that new environment, and I think in many respects some of the risks that we worried most about in this year will be much less worrisome next year.
You've said you expect inflation to fall in 2026 in both the US and the UK. Why are you so unconvinced by the sticky inflation narrative?
Well, it's driven by a couple of things. I think academic economists tend to see the world through a very distorted and strange lens to me. And in respect to the UK, I just think the OBR and the MPC have got some very odd views about inflation going forward, and I can talk about that in a bit more detail. In the US, you hear policymakers talking about sticky inflation. Ultimately, really, we're talking about energy prices and labour markets. I don't see anything on the horizon which drives energy prices up significantly. I'm talking about fossil fuel energy prices, related energy prices. Of course, electricity prices is a different issue. We can touch on that in a minute. But that, to my mind, is a relatively benign backdrop. Labour markets that you would worry about as a policymaker, if you were seeing tight labour markets, which ultimately lead to inflationary wage increases, or in wage increases that ultimately lead to inflation. If you're a policymaker and taking an objective view, I think what you see is a weaker labour market in the US in 2026 than in 2025. And if you're in the UK and you're a policymaker, you see the same thing. So I see inflation coming back down to target, perhaps a bit more quickly in the UK than policymakers are saying, and in the US, I think there are good reasons to see inflation coming down to back towards the 2% target through next year.
If we strip away the noise around tariffs and elections and central banks, what are the big forces you think will really drive markets in 2026?
Well, there are slightly different themes for different markets, but the AI industrial revolution is profoundly important. I saw a data set yesterday. Economist was arguing that 60% of growth in the US economy is directly attributable to AI infrastructure investment. So it's profoundly important to growth in the US economy, the most important economy globally. If you ask me about the UK economy, the most important driver really that I'm thinking about in relation to the UK is lower inflation, lower interest rates, and what that triggers in terms of household consumption. Those are the key macroeconomic themes that I see in the UK. So it depends on where you are. So they're different for different areas of the global economy. China, the dominant economic themes, I suppose, ultimately, China will continue to invest in the AI industrial revolution. They are in a competition with the US and equally feel that they can't come second in that race. So that will be a dominant theme in the economy. But perhaps more or of equal importance is the ongoing structural imbalance in the Chinese economy. And I think one thing that will sort of become quite a dominant theme for China next year is a product of their giant trade surplus, the $1.1 trillion trade surplus. Although exports to the US have come down following Trump's tariffs, China's export surplus with other countries around the world, and particularly with other Asian countries, has gone up significantly. And I saw today that Mexico has just applied a 50% tariff to to Chinese imports. And what that tells you is that there will be political ramifications around the world from that giant trade surplus, and that will be a challenge for China, which ultimately, what that means ultimately is that China has to get its domestic economy firing. It has to deliver a more balanced economic growth agenda, and that's all about stimulating domestic consumption.
Well, we'll come back at the end and ask how you'd actually construct a strategy. But let's start with the AI industrial revolution. You've pushed back strongly on the idea that we're just in a silly tech bubble. And you even said that because institutions like the IMF have warned about a sudden correction, that almost guarantees it won't happen going into 2026. Let's start with the big picture around AI. What does it mean to you going into 2026?
It's hard to quantify the scale of the importance of this industrial revolution. Many people who know much more about it than I do, and who have observed or understand how the US economy and the other industrialized economies have evolved over the last 200 years, look at the AI industrial revolution as the most important in the history of modern developed economies. It's hard, therefore, to underscore its importance going forwd. It's a key driver of the US economy. It's a key driver of the geopolitical confrontation between China and the US. Neither country believes it can come second in that race, and many commentators now believe that China has structural competitive advantage and may even be ahead of the US in many respects in relation to this race, which is going to have and is already having an important impact on the US economy. It's increasingly impacting not just the macroeconomy, but businesses more widely. More than 60% of US CEOs now mention AI in their quarterly statements. So the impact of AI on their business, it's ubiquitous and will become more ubiquitous as we go forward. If that isn't an oxymoron. Not only is it dominant as a key theme, it is driving an increasingly consensual US political view about what the US economy now needs to do. And in many respects, that was sort of represented in something which probably lots of people outside the US didn't pay very much attention to, which is something that the US produces every 4 years. It's called the National Security Strategy. Interesting in the context that in March next year, we'll see the 15th Chinese 5-year plan. And in some respects, it's a similar sort of document. What it highlights is very much the sort of strategic technological challenge that the US confronts, and why it needs to invest in certain areas of the economy to make sure that it retains and remains the leading player in many of these industries. And what's really important as well is that there is a growing political consensus in the US on both sides of the aisle about the strategic priorities enshrined in that national security plan. So that's really quite important.
This is already changing behavior.
Yes, it is. It's changing behavior in relation to, for example, a growing consensus in the US about a number of key policy areas. So, for example, on energy, there is a growing consensus about the requirement to invest in the US's energy infrastructure, on nuclear, for example, on some forms of renewable, on battery energy storage. There is now a consensus view about what the US economy now needs to do. There's a consensus about enabling the US economy really to achieve its technological leadership in many areas, not just in AI, but in biotech as well. There's a growing political consensus in the US about the US's requirement or need to secure access to critical minerals, for example. So it's really interesting that the perception of the US is that you've got a divided political sort of situation. Democrats and Republicans can't agree on anything. In fact, going forward, I think there is a growing consensus about really key economic areas or key economic issues, not least in relation to the AI industrial revolution and what that means for the US going forward. And that political consensus means that there's less policy uncertainty in the US economy going forward. Now, there is one important issue that I think is there are growing concerns about what AI will mean for the population. So, for example, more people are now worried about the impact of AI than are sort of looking forward to the benefits that will accrue from AI. And this, I think, is a product of two things: concerns about what AI does to the labor market, and secondly, what AI does to local energy prices. Because, of course, where data centers are being built at scale, the demand for power is changing, the supply-demand balance is changing, and energy prices are going up in following huge AI data center investments. And this, of course, ripples out across businesses and consumers, and of course has an impact. So this concern about what the downstream impacts of the AI industrial revolution will be on energy prices and on the labor market is starting to have an impact across the aisle, Republicans and Democrats. And there's a growing consensus about this. But on the other hand, of course, at the very same time that there is this growing sort of concern about what the implications of this industrial revolution are, you've got Donald Trump highlighting the fact that he will sign executive orders that prevent the states, individual state legislatures, getting in the way of AI infrastructure investment. So there is a sort of tension emerging between the sort of economic and geopolitical priority and the downstream impacts of what that means for local communities in relation to energy prices and labor markets. So that is a tension that is going to continue to grow in the US going forward. But aside from that, there is growing political consensus about what the US needs to do to maintain or compete with China in relation to energy policy, in relation to investment in key industries, in relation to biotech, for example, in relation to investment in quantum computing, in relation to investment in nuclear energy. All these things are becoming consensual views in the US.
So when people say this is just another dot-com bubble or a Ponzi scheme, it seems like they're just entirely missing the point.
I think they're missing the point. I think they're trivializing something which is profoundly much more important.
And there are some big risks, though, whether it's lack of progress or regulation or lack of availability of energy. There are risks in this revolution that could stop it or prevent it from playing out in the way that we think. How are you thinking about those?
I think if there was a major deterioration in the US labor market, if there were signs that deployment of AI was having a significant damaging effect on the US job market, that would be a challenge for AI. And of course, higher energy prices are something that US consumers are worried about. It's ironic, of course, because US energy prices are still a fraction of where they are in the UK, for example, or in Europe. It is ironic that the US consumer is sort of getting a bit sort of agitated about higher energy prices in the context of where they are in the UK and in Europe. It just highlights how far removed the EU and the UK economy are from sort of embracing what they need to do to capitalize on the AI industrial revolution. But anyway, that's a separate issue. The constraint or the thing that might restrain the AI industrial revolution in the US is if we started to see more exaggerated impacts on the labor market and on energy prices. And I think that's well understood in policy circles. And that's why, in part, we're seeing a sort of consensual view about committing to upgrading the US's energy infrastructure, investing in nuclear, investing in battery energy storage, investing in solar, investing in the whole energy complex to ensure that energy prices don't go up more than they need to, if you like. That's very important. The impact on the labor market is interesting. I think the fear of that at the moment is greater than the reality. At the moment, the data doesn't, as I've said earlier, doesn't really point to a significant deterioration or an identifiable deterioration in the labor market, which is directly attributable to AI investment. But I think it is an inevitability that there will come a time when it is having that impact, and that will clearly be a problem for policymakers, not just in the US, but in every democratic economy. That's a challenge that will confront policymakers everywhere. And I'm not quite sure how that gets resolved. Maybe universal basic income is the solution in time, but there might be quite a rough ride on the way to universal basic income. So that's a challenge for all democratic societies. Obviously, less of a challenge for the Chinese economy because of the way its political system works.
Well, we did a whole episode earlier in the year about why we don't buy the fact that this is just a bubble, why this isn't an AI bubble. We'll link that in the description down below. And also there'll be a link in the corner of the video now for anyone who wants to pause this and find out Neil's view on whether it's a bubble or not. Let's talk about China. It's had a very complicated few years, the property market problems, deflationary pressure, weak consumption. Let's separate the domestic economy from the stock market story. What's really going on in the Chinese domestic economy right now?
Look, it's got major challenges, and they haven't really got significantly better. Arguably, the property market has stabilized, but prices are still falling in the second and third tier cities. Not as much as they were, but prices are still down. Domestic consumption is still subdued. I'm not sure I believe the GDP data. The economy is really grappling with sort of a deflationary situation. I mean, inflation is expected to be just above, I think IMF and OECD see inflation in China slightly above zero next year. But you know, it's grappling with a deflationary economic environment. Policymakers have taken steps to clamp down on excessively aggressive price competition in industries where there is surplus capacity. So, yeah, at the margin, policymakers are beginning to sort of, you know, to address these issues. But I think if the economy is going to become more robust in the future, there has to be this fundamental shift away from a dependence on manufacturing and exports to domestic consumption. I think policymakers understand that, know that, recognize that. And bit by bit, I think there will be more and more policy designed or targeted to deliver that outcome. It is a challenge, though. You know, persuading 1.2 billion consumers to save less and consume more is not an easy task.
Are there specific policy interventions you're expecting to see in 2026?
Well, more of the same, really. More of the same sorts of policy interventions we've seen already. I think they need to be bigger, bolder, and have greater impact. Thus far, the policy initiatives have been relatively timid, I would argue, and as a result, haven't really significantly changed. On the face of it, the policy initiatives have not delivered yet the outcome that the Chinese government wants. So logically, one should expect more of the same.
On the geopolitics side, how important are the meetings between President Xi and President Trump and easing those tensions? How important is that for the growth of the economy?
It is very important because the economy is so dependent on exports. I mean, a 1.1 trillion export surplus is clearly of profound importance to the economy. In general terms, the Xi-Trump summits that we're going to see, I think there'll be 2 through 2026, are really important because I think they just take the heat out of and de-risk one of the biggest sort of areas of concern that investors had in 2025, which is where the tariff war would take China and the US. Where would it eventually lead to? How would that escalating tension, develop? Now that the tension has sort of been de-escalated and now we're looking forward to sort of face-to-face summits, I think that policy uncertainty, the removal of that policy uncertainty is very important.
For years, we've heard the line that China is uninvestable. Yet you've pointed out that already this year, Chinese tech and AI companies have re-rated upwards, but you still see more upside. What are investors just getting wrong? And when do you think they'll start to see the light?
Well, I think investors got it wrong at the start of last year. Investment banks were saying China's uninvestable. That was nonsense. China has got lots of challenges, but it was absolutely not uninvestable. Now, I think China's performance this year, Hong Kong, Chinese stock market, and particularly the performance of China's leading tech companies, has highlighted how silly that view was. In the US in particular, I think there is a growing awareness that China's technology is much more competitive. Their prowess in biotech, for example, is gradually becoming better understood. I think in 2024, China filed 27 times more patents than the US did. It's not always a measure of technology prowess, but nevertheless, it's a sort of soft indicator of I think a growing awareness in the US that China's technology should not be underestimated in AI, in biotech, or anywhere else. So I think there is more respect now in the US for China's technological prowess. And I think now that China has shown that it can perform after years of massive underperformance against the US, I think there may well be an increasing sort of desire, I think, in the US to sort of look at the Chinese Chinese equity markets and certainly Chinese leading technology companies as a more credible place to invest in portfolios than it has in the recent past.
And what are the big risks you worry about with China?
The biggest risks I see in China really are related to the same old problems, really, which is that the economy is very unbalanced. It's grappling with long-term structural challenges, declining aging population, an unbalanced economy in which household consumption is way below where it should be in a modern, developed, strong economy. Its dependence, therefore, on manufacturing and exports is the challenge. Because I think increasingly, just as the US reached a breaking point where it said that no more, we're going to have to take action. Obviously, it required different political leadership, but we're going to take action to prevent Chinese manufacturers dominating our economy. And we do not, as an economy, want to become too dependent on access to key raw materials or manufacturing. We don't want to cede ground, any more economic ground, to China's export or manufacturing industry. And that hasn't just affected the US economy. It's clearly having an impact on the EU as well. It is going to have an impact on emerging economies across Asia, Latin America, and the rest of the world. So I think China's dependence on growth on manufacturing and exports, which are obviously two sides of the same coin to some extent, is a potential weakness, and that's why it's so important that China is able to continue to move towards rebalancing the economy towards stronger growth in domestic consumption.
Well, we'll come back to how China would fit into a global strategy later in the episode. But let's talk about the US now. In last year's outlook, you said the consensus on US growth was too gloomy. That largely turned out to be right. This year, again, I think you're more optimistic than some of the official forecasts. Why do you think the US once again will beat the pessimistic growth forecast going into 2026?
There are a number of key pillars. I mean, clearly, the US will invest more in AI industrial infrastructure next year than it did in 2025. Now, the growth rate it may slow a little, but there will be a growth impetus still from AI infrastructure investment, significant. The US will also benefit from lower interest rates, just as the UK economy will. Many of Trump's policies, which I've talked about through 2025, not just in relation to AI, but in relation to, for example, the reshoring of US semiconductor manufacturing, the reshoring of pharmaceutical manufacturing. All of these things have resulted in significant commitments from global companies to invest in US domestic infrastructure to ensure that they don't fall foul of Trump's targeted Trump's targeted tariff measures. So the pharmaceutical industry is a great example. Most of the world's largest pharma companies are now recommitting to significant investment in US manufacturing. I saw today that the ex-head of Glaxo said unequivocally that the US was the best economy for investment going forward. So it's not just about AI; it's also about all these other key industries, biotech, automotive manufacturers as well. So I see the US economy in 2026 benefiting from lower inflation, lower interest rates, but also this significant increase in the renaissance of US manufacturing industry. I don't think should be underestimated.
And what else do you think that we need to know about the US as an economy? What else is going to drive that resilience?
What the National Security Strategy document highlights is the need for the US to prioritize investment and support behind key industries going forward. One analyst I listened to recently described this as a sort of Sputnik moment, which was the moment when the US economy was shocked into saying, oh my God, we might be behind in the technology race with Russia. We need to start to sort of get our act together. And then within a few years, as I say, Apollo 11 was launched and two men were walking on the moon. The National Security Strategy document highlights some key areas where there is growing political consensus in the US about what needs to happen. So, for example, the first one is that the US supply chain needs to be secured for critical minerals. That's growing political consensus, and the US is going to put a lot of investment behind securing access to those critical minerals and reducing its reliance on China in that respect. A critical investment in quantum computing, where the US has a lead. Quantum computing is going to be hugely important in the future, arguably maybe even more important than the AI industrial revolution. And that is another priority in this document. The third priority is the reshoring of semiconductor manufacturing capacity. I've already mentioned that. That's very important. And this is, again, an area where there is growing political consensus. The biotech industry is one where the US feels it cannot come second to China. And given what I said earlier about the number of patents that were filed in China relative to the ones filed in the US, the US has had a shock, really. The view is, the China's biotech industry is a far more impressive beast than the US had previously understood. And of course, defense technology is another area. All these strategic priorities, in a way, highlight perhaps this sort of quite significant shift away from this idea that the market will look after everything in the US, and what it highlights is a slightly more interventionist, more sort of strategic view from the government about what the US economy needs to do, and it reminds me of that Sputnik moment that we saw in the 60s.
You've been clear this year that you don't believe in the bubble bursting narrative for US tech, but you're still not bullish on the overall S&P 500. What is the problem?
The S&P has historically been a very diversified index, and it is increasingly less diversified, more concentrated, 41% in the top 10. And those top 10 are all companies where I believe the valuations are hard to justify. Indeed, nigh on impossible to justify in many respects. So I need go no further than that. I think there are lots of opportunities in the weeds in the US equity market and in the small and mid cap areas of the market. But the index itself, I think, is constrained in my mind by the fact that it's the 10 and more largest companies are trading on valuations which I think are excessive.
We talked last week, and I'll leave the link in the description and in the video link in the top right. When people talk about the US being on the brink of another 2008 because of private credit, consumer debt, and so on, how does that risk factor into your thinking going into next year?
Most of the scare stories I see on the internet are ludicrous, frankly. I mean, and there are so many of them. It's hard to keep track of all of them. I don't see any substance behind most of them. There is some substance behind some of the concerns around, for example, the growth of private credit. But the more I've dug into those concerns and the more I've looked at the nature of the private credit market, the more reassured I am that actually it's a sign of a more robust lending environment in a credit environment in the US than it is the sign of something that's out of control or akin to the mortgage madness that resulted in the financial crisis back in 2008. So I don't share those views.
The popular narrative about the US feels split. Either America is unstoppable or America's best days are behind it. Where do you sit between those two extremes?
I don't really sit in either camp. I mean, the US is unstoppable. The US is the strongest economy globally. It is the dominant geopolitical power globally, but it has a close rival in China. China has all sorts of competitive advantages relative to the US, but equally, I think it's easy to ignore the competitive advantage that the US has over China. The US is sort of not unstoppable. The US is an incredibly powerful economy. It will be a dominant force. It has eclipsed the EU economy in so many ways and will continue to do so, in my view. The US economy, I don't subscribe to the view that the US economy's best days are behind it at all. No, I think there's a very exciting future for the US economy. And I hope that an economy like the UK can ride on the coattails of that success.
Well, let's talk about the UK next. I think it's the area where you're most out of line with the consensus view. And in your 2025 outlook, you said the UK would beat the doom-laden consensus. It did. What's your view going into 2026?
The doom-laden consensus is still so wrong. And in fact, if anything, even more wrong, in my view, for 2026 than it was for 2025. The MPC is forecasting growth of 1.2%. The OBR is at 1.4%. I think the IMF is somewhere close to those numbers, as well as is the OECD. They're just all wrong, as they were wrong at the start of last year. I think growth will be something like 2% in the UK next year. What we're seeing, lower inflation, lower interest rates will drive higher spending, less saving. I just see that as an inevitability. I'm not expecting households to stop saving completely, but the very high saving rates that we've seen in recent years in the UK just will come down a bit, and consumption growth will be better than people think. Alongside that, we know that government spending's growing. We're all paying for it in higher taxes, but government spending is increasing. That's a help to growth. Perhaps the biggest difference between my view, interestingly, and the consensus view is that I see the growth in investment spending, which significantly outperformed consensus views this year, will continue to grow next year. So a combination of better government spending, better investment spending, and more household consumption will drive growth in the economy, which will beat consensus forecasts.
When people say UK stocks are cheap for a reason, what do you think is the key piece of information they're ignoring?
I just think they're wrong. I think what they're conditioned by is history, the recent history, which is that the UK equity market has underperformed its global peers for far too long. But I think I think that view that there's some sort of structural problem in the UK is flawed. I think it's a product of a lazy sort of consensus view. Well, the UK's always been pretty rubbish, therefore it'll carry on being rubbish. And that's just not an accurate reflection of the fundamentals of the UK economy. There's nothing structurally wrong with the UK. There are lots of challenges in the UK and many things that could be a lot better than they are. But nevertheless, there's nothing structurally wrong with the UK economy. And I believe it will respond to the things that I've just talked about. So the economy will deliver better growth. Businesses will, as a result of that, deliver better growth in earnings, profits, and that will be a surprise for investors more generally. But also, of course, as the economy performs better and as the underlying businesses that are listed on the London market and which are exposed to the UK economy perform better, so people will be, I think, sort of drawn to the undervaluation of the UK equity market. And the first step, I think, will be reflected in less disinvestment from the UK. The performance of the UK index this year has been remarkable in many respects, not least because a record 26 billion was withdrawn from the UK by domestic investors this year alone. So despite that disinvestment, ongoing disinvestment, the UK equity market performed really well in 2025. And I see outperformance from the economy, from businesses, driving a shift in attitude to the UK equity market and another year of good performance going forward. Another year of surprisingly good performance.
What are the main risks to your UK thesis?
I think another daft budget would be a major risk, but I think the probability of Rachel Reeves making the same mistakes again in October next year are vanishingly small. The UK economy is a very open economy, and so it's always exposed to the slings and arrows of the global economy. So if there was some sort of event that at the moment is that I can't forecast because I can't see it occurring. There isn't anything I can say. Oh yes, Russia's going to invade Ukraine. I mean, do you see what I mean? I mean that was a completely unforecastable event in my mind, and it surprised most people. So barring some sort of unforecastable event like that, I can't really see too many things on the horizon that undermine my sort of underlying confidence about the UK economy and the UK stock market.
Okay, well, if you had to answer the line, the UK is a basket case with high unemployment, no growth, stocks are cheap because they're bad businesses, how would you respond to that? Because that's what the popular narrative is saying.
But none of that is true. None of it's true. The UK economy hasn't been low growth. It's been low growth in relation to the US, but we've not been low growth in relation to our European peers. We have grown more strongly in 2025 than our European peers, significantly stronger. Our recent growth record in relation to the EU has been pretty much identical over the period since the Brexit vote and over the period since we actually left in 2020. So this argument that Brexit delivered some sort of giant economic headache for the UK economy, which completely crippled our ability to grow, I mean, it's just not reflected in the facts. It might be reflected in the imagination of the people who want to blame Brexit for everything. The UK economy is not structurally disadvantaged. It has grown trade post leaving the EU as fast with the EU as it has with the rest of the world. The economy has grown more strongly recently than the rest of the EU. The UK economy and the UK stock market is populated with great businesses. Just it's wrong to view the UK economy as sort of having a population of companies that somehow are disadvantaged or poorly led or economically crippled. I mean, it's just a narrative that's totally false.
Well, we've already done a full episode on both the UK budget and whether Britain is broken. We'll link to those in the description. If you haven't watched that, that will give you a lot more political context behind Neil's view. In a few minutes, we're going to put all this together into a strategy view. But before we do that, if you're still watching and you want to hear more of these conversations, don't forget to hit like and subscribe. Tell us in the comments whether you agree with Neil on the UK. Is it still uninvestable, Or is this where the real opportunity could lie? Let's bring the EU into this, because last year you were pretty blunt and you said you'd avoid Europe entirely. What does the European economy look like going into 2026?
In some respects, I was right about the economy. The EU has had a poor year of growth, really, on average. Germany's really struggled to deliver any growth at all. France, of course, the other second biggest economy in Europe, is struggling as well. Some of the economies in the periphery, like Poland and Spain, for example, have grown pretty strongly. But they're just not big enough to move the EU dial overall. So growth in the EU economy has been poor and significantly behind growth in the UK, for example. And so in that respect, I suppose I was right. What I was wrong about was that in general, EU stock markets have performed pretty well. So the Euro Stoxx is up, I think, about 16.5% this year, behind the FTSE 100. About in line with the S&P, actually. So performance in European stock markets has been pretty good, but the economy has not been good. So the ECB has responded to that poor growth picture by cutting rates very aggressively. So rates are now down at 2% in the Eurozone. And you would expect that as a result of that pretty significant monetary stimulus, that you'd see a better economic picture in 2026 than we saw in 2025. At the margin, I'm a little bit more optimistic about the economy responding to that monetary stimulus. Low growth is not just a product of tight monetary policy, and now we should see higher growth because monetary policy has been eased so significantly. Europe clearly has structural problems. Those structural problems are many and varied. The EU economy is crippled in some respects by the challenges it's had to confront since Donald Trump became the US president. Basically, the EU has had to confront the fact, or Europe has had to confront the fact, that it has to pay for its own defense. And that defense challenge is obviously a clear and present danger given what's going on in Ukraine. So that whole issue has dominated European politics this year and will continue to do so. But Europe, bigger and broader than that, is Europe's sort of stifling bureaucracy, Europe's stifling regulation. It's ludicrously high energy prices, another problem that the UK confronts. These structural challenges should not be underestimated. And we've already talked about how the US and China, how important access to energy is and access to cheap energy is in relation to driving the AI industrial revolution. When you've got energy prices as high as they are in Europe, it's hard to see how that massive hurdle can be overcome. I don't know how the EU confronts those challenges. The UK confronts many of the same ones. So this isn't just an issue about the EU. It is a major problem for the UK. And if anything, energy prices in the UK are even higher than they are in the EU. So, these challenges will not go away. Now, I do get the sense that in France and in Germany, there is a growing awareness about these challenges and a growing awareness that they need to be confronted. The Italian Prime Minister has clearly well understands these challenges too, but getting action on them is difficult because 27 countries need to build a consensus, it seems to me, to get anything done in the EU these days. Germany is embarking on a significant fiscal stimulus, which could be very significant for the German economy going forward, but we'll have to see how that plays out. It'll take some time to show up, I think, in GDP data. But if the German leadership are committed to this fiscal stimulus, it is of a significant scale. But my sense is that these structural challenges confronting Europe need to be grappled with quickly. Otherwise, the EU will continue to lag behind the US and China and be diminished as a result of that, I'm afraid.
So the EU is still a story of missed opportunities.
The valuations really, at a headline level, are not that attractive. They're at a premium to the UK, significant premium to the UK. But there are some really interesting areas of Europe. Rather like the US, it's wrong to condemn an entire market, say, "Oh, everything in that market is unattractive." Clearly, that's not the case. Um, an index position in the S&P 500 is something I wouldn't want to take, and equally an index position in the Euro stocks is something I wouldn't want to take. But there are some really interesting companies, some really attractive opportunities across the European equity markets.
Well, if you're watching this and you've got a different take on Europe, maybe you're bullish on EU defence or on the energy transition, let us know in the comments. Neil and I read every single comment, and it's something that we may come back to in a future episode. Neil, we've talked through the big forces for 2026. Let's put some structure around it. I want to talk to you about how you would think about building a real-world strategy for 2026 by geography and by sector, and thinking about where you'd be relatively underweight or what you might just avoid altogether. How would you think about constructing an investment strategy for 2026, given what we've talked about?
Many of the things that I talked about a year ago, I would still highlight as attractive today. So although it's been a busy year, and although lots of things have evolved, fundamentally, the things that I thought were attractive 12 months ago, I believe are still attractive now. And the things equally that I didn't think were attractive then, I continue to believe are relatively unattractive now too.
Let's start geographically. If you imagine a strategy you're running globally, how would you think about the rough geographical breakdown?
Let me try to summarize it quickly. I wouldn't own an S&P 500 index position. I think there are very interesting opportunities in the US, in the weeds. And I talked last year about the picks and shovels suppliers to the AI industrial revolution. I still believe in those. And I talked about the biotech sector, the healthcare sector, and I still see that as attractive. But I wouldn't own the S&P 500. Coming across the Atlantic, I would own the UK. I think it is the most attractive developed economy market. It is undervalued, structurally undervalued, and the economy is going to outperform. And I believe as a result of that, many sectors exposed to the domestic economy will deliver earnings outcomes that will beat consensus. Europe, again, similar to the US, I wouldn't own index positions in the Euro stocks, but equally, as in the US, there are some really interesting undervalued situations across Europe, perhaps slightly less interesting than they were at the start of last year, but nevertheless still interesting because they performed pretty well, some of them, in the last 12 months. In China, I think it's a similar story. China's had a great year in 2025 in performance in equity market terms. Its leading technology stocks have performed very well. When I look at the valuations, I still see significant attraction. So in a way, a very similar theme to that which I held 12 months ago. If you were to apply a conviction indicator to some of those views, I'd have slightly less conviction on China, slightly less conviction on some of the things that have just performed very well. But remember, we are a year further forward, and so the earnings ratings looking forward are not as demanding as they might have been, of course. And given the growth that's been delivered in some of these companies, the valuations have not really shifted that dramatically, despite the fact that their share prices have performed pretty well. The other thing I should mention is that at the start of last year, I talked about the attraction of 10-year gilts in the UK. Inflation is now coming down significantly, and I see inflation coming down to target in 2026. I think that's going to be a very strong tailwind for official interest rates, and of course, as by implication, for 10-year gilt yields too.
Let's drill down into the sectors, because your approach isn't to just buy everything. Which sectors globally are you looking at, or do you favour going into 2026?
So I still see opportunities in picks and shovel suppliers to the AI industrial revolution. That continues. The semiconductor cycle, I think, is gathering momentum. So the semiconductor sector is one that I continue to like, and where valuations are still pretty low. I talked about the biotech sector. I still like the biotech sector. Interestingly, after years of underperformance, it's just started to perform much better in the US. And that's in part the product of, again, one of the things I highlighted, which is that the approaching patent cliff in 2030 that most of the global pharma companies confront is going to drive more M&A in the biotech sector. And we've already started to see that happen in 2025, and I think it'll gather momentum next year. In the UK, which of course doesn't have a semiconductor sector, doesn't have a biotech sector, the story is quite different, but I think as attractive. And there, I as a result of an economy that's going to smash consensus, as a result of that, businesses, sectors that are exposed to the domestic economy will, I think, continue to perform well. Some performed well in 2025, some didn't. So I see those domestic sectors performing much better in 2026. As I think the economy, interest rates, inflation, as all of these things surprise to the upside, I think that drives a sort of growing appreciation of the undervaluation of the UK equity market, and in particular those domestic sectors. Financials, banks in particular, performed well through 2025, but I expect that to continue for some of the reasons I've already highlighted. In Europe, I'm not. Again, I wouldn't own the index position, but I would look at some of the picks and shovel suppliers that exist in Europe that have performed well in 25, and I think I would expect to continue to perform well. There's a semiconductor sector in some respects across Europe, and that cycle, I believe, is recovering strongly, and I see some major beneficiaries across that sector in Europe. And in China, the same technology sort of plays that I was enthusiastic about at the start of last year, and I've already talked about 10-year gilts. I think 10-year gilts will perform well this year.
Is there anything you would say to people who are watching who might be tempted to make really aggressive changes based on a single year's outlook?
No, I'm never a great believer in sort of the date changes, therefore you sort of ditch everything and start afresh. The world isn't like that. The real world is not like that at all. The date changes, but many things don't. Many things that are very important for investment strategies don't change. So the continuity should be really the sort of watchword, frankly, for the way people think about what they should do with their investment strategy. There's no good reason to change anything unless fundamental economic or market environments have changed. And I don't see those have changed significantly at all. In fact, in many respects, there are very few changes. I mean, I've talked about some of the interesting geopolitical developments that I think I see playing out in 2026 already. But I think the elements of those geopolitical changes have been very obvious already in 2025.
Neil, I think let's leave it there. We've covered a lot of ground today. We've walked through your big calls of 2026, AI, China, US, UK, and Europe, and which sectors could benefit from a world of falling inflation. If you found this useful, please hit like so that more people get to see it, and subscribe if you haven't already. And don't forget to tell us in the comments which parts of Neil's outlook you most agree or disagree with. We do read every single comment, and Neil and I will do our best to respond to them. And we may even pick out some of the best questions and challenges for a future episode. Neil, thank you as always for your time. We'll see you next year. And For everyone who's listening who'd like more from this channel, you can take a look through some of those older episodes. Hopefully you'll find something useful. We'll be back in January. Until then, take care.